Hey there, fellow investors. Welcome back to another insightful session on mastering financial metrics. Today we're diving into the exciting world of financial ratios, specifically the debt-to-equity ratio. This ratio is a cornerstone in understanding a company's financial structure. This ratio is like a sneak peek into a company's financial health. It provides a snapshot of how a company is balancing its debt and equity to finance its operations. It tells us how much debt a company is using to finance its assets compared to its equity. Essentially, it shows the proportion of company financing that comes from creditors and investors. Think of it as a financial stress test. Just like a stress test reveals the health of your heart, the debt-to-equity ratio reveals the financial robustness of a company. A high debt-to-equity ratio can be a red flag signaling potential risks. It may indicate that a company is over-leveraged and might struggle to meet its debt obligations, but don't worry, we'll break it all down in plain English. We'll explore what constitutes a healthy ratio and how to interpret different levels of debt to equity. So, whether you're a seasoned investor or just starting, understanding the debt to equity ratio is crucial. It's a fundamental tool for evaluating the financial stability and risk profile of a company. It's like having a secret weapon in your investment arsenal. With this knowledge, you can make more informed decisions and potentially avoid risky investments. By the end of this essay, you'll be able to analyze companies like a pro, assessing their financial risk and making informed investment decisions. Let's get started on this journey to financial mastery. Now let's define this all-important ratio, which is crucial for understanding a company's financial health. The debt-to-equity ratio, often shortened to DE ratio, is a key financial metric used by investors and analysts. It measures the proportion of a company's financing that comes from debt compared to equity, providing insight into the company's financial structure. In simpler terms, it shows how much debt a company is using to fund its operations relative to the money invested by its owners, which is crucial for assessing financial risk. A high DE ratio indicates that a company relies heavily on borrowed money to operate, which can be a red flag for potential investors. This can be risky, as it increases the company's financial leverage, making it more vulnerable to economic downturns and interest rate hikes. Financial leverage, like a double-edged sword, can amplify both profits and losses, making it a critical factor in financial planning and strategy. On the other hand, a low DE ratio suggests that a company uses less debt and relies more on equity financing, which can be seen as a safer, more conservative approach. Companies with lower DE ratios are generally considered to be in a stronger financial position, as they are less burdened by debt obligations. Understanding the DE ratio helps investors make informed decisions about the financial stability and risk profile of a company, guiding their investment choices. Calculating the DE ratio is easier than you might think. It's simply dividing a company's total debt by its shareholder equity. You can find these figures on a company's balance sheet, a financial statement that provides a snapshot of its assets, liabilities, and equity at a specific point in time. For example, let's say company XYZ has $50 million in total debt and $100 million in shareholder equity. To calculate its DE ratio, we divide the debt $50 million by the equity, $100 million, resulting in a DE ratio of 0.5. This means that for every dollar of equity, company XYZ has 50 cents of debt. Now that we know how to calculate the DE ratio, let's delve deeper into understanding what these numbers truly signify for a business. A high DE ratio, typically above 2, suggests that a company has a high level of debt relative to its equity. This can be a red flag for investors and stakeholders. Such a high ratio can indicate higher financial risk, as the company is more vulnerable to economic downturns or interest rate hikes. In times of economic instability, companies with high debt may struggle to meet their financial obligations. Conversely, a low DE ratio, generally below 1, indicates that a company has a lower level of debt compared to its equity. This often reflects a more stable financial position. This suggests lower financial risk and a more conservative approach to financing. Companies with low debt levels are often better positioned to weather economic storms and take advantage of growth opportunities. However, it's important to note that there is no one-size-fits-all ideal DE ratio. What works for one company might not be suitable for another. The optimal ratio varies depending on the industry, company size, and growth stage. For instance, tech startups might have different debt levels compared to established manufacturing firms. Understanding the context is key to interpreting the DE ratio accurately. Section 5. The DE ratio for investors assessing risk and return. For investors, the DE ratio is a valuable tool for assessing potential investments. It helps gauge a company's financial risk and potential return. A high DE ratio may signal higher volatility and risk, but it can also offer the potential for higher returns. Conversely, a low DE ratio may indicate lower risk and volatility, but it might also come with lower potential returns. Investors should consider their risk tolerance and investment goals when evaluating a company's DE ratio. Section 6. The DE ratio for lenders gauging creditworthiness. Lenders such as banks and financial institutions rely heavily on the DE ratio to assess a company's creditworthiness. Before approving a loan, lenders want to ensure that the borrower has the financial capacity to repay the debt. A high DE ratio raises concerns for lenders as it suggests a higher risk of default. Lenders may be hesitant to lend to companies with high DE ratios or may charge higher interest rates to compensate for the increased risk. A low DE ratio, on the other hand, instills confidence in lenders, indicating a lower risk of default. Section 7. The DE ratio for management, a tool for strategic decision-making. Beyond investors and lenders, the DE ratio is also a vital tool for company management. It helps management make strategic decisions regarding financing, capital structure, and overall financial health. By monitoring the DE ratio, management can identify potential areas of concern and take corrective action. For instance, if the DE ratio is too high, management may consider reducing debt by paying it down or issuing new equity. Conversely, if the DE ratio is too low, management may explore opportunities to leverage debt financing for growth initiatives. Section 8. DE ratios across industries, a comparative perspective. It's important to note that DE ratios can vary significantly across different industries and sectors. Some industries, such as utilities and telecommunications, are known for their high DE ratios due to their capital-intensive nature. Other industries, like technology and consumer discretionary, may have lower DE ratios due to their asset-light business models. Therefore, it's crucial to compare a company's DE ratio to its industry peers to gain a truly meaningful perspective. Section 9. Limitations of the DE ratio, a caveat to consider. While the DE ratio is a valuable financial metric, it's not without its limitations and potential pitfalls. One significant limitation is that it doesn't provide information about the company's ability to generate cash flow to service its debt obligations. A company with a high DE ratio but strong cash flow generation might still be considered financially healthy and stable. Additionally, the DE ratio can be influenced by various accounting practices, such as the treatment of leases and pensions. Section 10. Combining the DE ratio with other metrics, a holistic approach. To overcome the limitations of the DE ratio, it's essential to use it in conjunction with other financial ratios and metrics. For instance, investors can consider the company's interest coverage ratio, which measures its ability to meet its interest payments. Other useful metrics include the debt-to-asset ratio, the current ratio, and the quick ratio. By analyzing a company's financials holistically, investors can gain a more comprehensive understanding of its financial health and risk profile. Section 11. Conclusion. The enduring relevance of the DE ratio. In conclusion, the debt-to-equity ratio remains a cornerstone of financial analysis, providing valuable insights into a company's leverage, risk, and overall financial health. By understanding the DE ratio, investors, lenders, and management can make more informed decisions. However, it's crucial to remember that the DE ratio is just one piece of the puzzle. A thorough financial analysis requires considering multiple ratios, industry trends, and qualitative factors. By combining quantitative and qualitative analysis, investors and stakeholders can gain a holistic view of a company's financial standing and make sound decisions.